You built it, right? Off the grid, self-contained, independent. Solar panels pulling energy from the sun, batteries storing it for the night, a deep well tapping into water no one can shut off. Maybe you even reinforced the structure, added cameras, thought through every scenario. The goal was simple: remove dependency. Build something that survives no matter what happens outside. And for a while, it works, quietly. While prices rise and systems get unstable, your setup keeps running. You're not immune, but you're insulated, less exposed, more in control. Then, a letter arrives. Official seal, county notice. Routine, at least at first glance. You open it, expecting paperwork, maybe a minor adjustment. It's a bill. Property taxes. Higher than last year. Noticeably higher. A fixed number with a fixed deadline. No negotiation, no flexibility built into it. Just an obligation. You hesitate. Cash flow is tighter this year. Maybe you wait, just for now. Nothing dramatic happens immediately. That's the part that lulls you. But quietly, the pressure builds. Penalties stack. Interest accumulates. The tone of the letters changes, subtle at first, then firm. And then one day, someone shows up. Not aggressively, not violently, just officially. A sheriff or a representative holding paperwork that carries more weight than everything you built. Pause for a second, because this is the moment the illusion breaks. You can be completely self-sufficient and still lose everything. Not because you failed to survive on the land, but because you failed to pay to remain on it. This is where the idea of ownership starts to unravel a little, and not in an obvious way. Most people grow up with a simple belief. You buy a piece of land, you pay it off, and eventually it's yours, fully yours. No bank, no lender, no obligations, just you and the property. But that's not how the system is actually structured. Because even after the mortgage is gone, the payment never really stops. It just changes form. Property tax is not a temporary fee. It's not something that expires once you've paid your dues. It's permanent. It exists for as long as you hold the land, and it must be paid continuously, regardless of your personal situation, your income, or how productive that land is for you. And that leads to a very different interpretation of ownership. You don't own the land in an absolute sense. You hold the right to occupy it as long as you continue to pay for that right. Pause for a second and sit with that, because it flips the model completely. Instead of ownership being a one-time transaction, it becomes an ongoing relationship with the system that governs that land, a relationship defined by recurring payment. Miss that payment, and the system doesn't negotiate with your circumstances, it enforces its claim. And this is where the idea of perpetual rent comes in. It's not called that. It's framed as taxation, as civic contribution, as a necessary part of maintaining infrastructure and public services. And in many ways, that framing is valid. But mechanically, the effect is similar to rent. It's a recurring cost tied to your continued use of the property. Except, unlike rent in a private contract, you can't renegotiate it. You can't shop for a better rate. You can't pause it when income drops. It exists independently of your ability to pay. And that's the critical point. Because most people plan for the purchase of a property. They plan for the mortgage. They calculate affordability based on income at the time of purchase. But they don't always plan for the long tail. The years, sometimes decades, where circumstances can change, income can drop, markets can shift, unexpected events can disrupt cash flow. And through all of that, the obligation remains constant. So the risk isn't just buying something you can't afford. It's holding something you can't continuously service. And once you see it that way, the question changes. It's no longer, can I buy this land? It becomes, can I afford to keep paying for it, no matter what happens next? If this still feels like an edge case, history gives a much more brutal version.
one where the same mechanism played out across an entire country, quietly stripping land from people who thought they already owned it. Look at what happened during the Great Depression. Most people remember the headlines: stock market crashes, banks failing, unemployment surging. But what's less talked about is what happened on the land itself, especially in rural America. Farmers began losing property they had already paid for. No mortgage, no bank leverage hanging over them. In many cases, these were multi-generational farms, land that had been cleared, worked, and improved over decades. By every common definition, these families owned their land. But that definition didn't hold under pressure. Before the collapse, the system worked. Crop prices were high enough to sustain operations. A farmer could sell wheat, corn, or cotton and generate enough cash to cover expenses, including taxes. The cycle was stable, predictable. Even if margins weren't huge, they were sufficient. Then the prices broke. And they didn't just dip, they collapsed. Wheat prices dropped so low that selling crops barely covered the cost of harvesting them. Cotton followed the same path. Livestock prices weakened. Everything that farmers relied on for income suddenly produced far less cash. But here's the critical part. The land didn't stop producing. The farms were still there. Crops were still being grown. Food still existed. In physical terms, nothing had collapsed. But financially, everything had. Because the system didn't run on crops. It ran on cash. Pause for a second and sit with that contradiction. A farmer could be surrounded by value, acres of land, growing food, real productive output, and still be unable to meet a single obligation if that value couldn't be converted into dollars at the required time. And property taxes demanded dollars. They didn't adjust to market prices. They didn't scale down just because crop revenue collapsed. They were assessed based on land valuation, not on what the land was currently earning. So even farmers who were operating efficiently, even those with no debt, suddenly faced a fixed obligation that no longer matched their income reality. And when that gap opened, the process began. At first, it didn't look catastrophic. A missed payment, a delay, maybe a partial payment, but penalties accumulated. Interest was added. Notices were sent. The system didn't react emotionally. It reacted mechanically. Then came enforcement. Counties began seizing land for unpaid taxes. Auctions were scheduled. Properties were sold, often at prices far below their real value, to anyone with available cash, sometimes to neighbors, sometimes to outside investors, sometimes to speculators who understood exactly what was happening. And this is where the wealth transfer occurred. Not through a dramatic collapse, but through a quiet process. Cash-rich buyers acquired productive land from cash-poor owners. Not because the land had lost value, but because the owners had lost liquidity. The asset was still there, the productivity was still there, but the ability to meet a fixed cash-based obligation had disappeared. So ownership changed hands. Now think about the psychological side of this. These weren't reckless people. These weren't speculators who took on too much risk. Many of them had done everything right. They worked the land, paid off debts, built something stable over time. But they were operating under one assumption, that once the land was paid for, it was theirs. And that assumption broke, because the system didn't recognize paid off as the end of obligation. It recognized ongoing compliance, continuous payment. And when that payment stopped, the system didn't pause to consider context. It enforced. And here's the part most people overlook. This didn't happen to a handful of farms. It happened at scale. Entire communities affected, generations displaced, land consolidated into fewer hands, not through violence, not through obvious confiscation, but through a legal process tied to unpaid taxes. Now bring that forward. The structure hasn't changed. Property taxes still operate the same way. They are assessed independently of your current income. They do not pause when your cash flow collapses. They do not adjust in real time to your personal situation. They exist as a fixed obligation tied to the asset, not your ability to service it. which means the same vulnerability still exists. You can own valuable land, you can be debt-free, you can even be productive in a physical sense. But if you cannot generate the required cash at the required time, the system treats that the same as failure. And that's the uncomfortable truth. You don't lose property because it stops being valuable. You lose it because you can't keep paying for the right to hold it.
If the historical version of this mechanism feels distant, the modern version is far more structured and, in some ways, more efficient. Because today, the process of taking property through unpaid taxes isn't chaotic. It's institutionalized. Here's how it works. When a property owner fails to pay their taxes, the local government doesn't just wait indefinitely. It needs revenue. Schools, infrastructure, services, they depend on that cash flow. So instead of holding the risk themselves, municipalities convert that unpaid obligation into a financial asset. They sell it. Specifically, they sell what's called a tax lien. This lien represents the right to collect the unpaid taxes, along with penalties and interest. And it's sold to investors, sometimes individuals, sometimes large institutions, often at a discount. Now, pause for a second, because from the outside, this looks like a minor administrative detail, but it changes the entire dynamic. The person who now holds that lien isn't emotionally connected to the property. They didn't grow up there, they didn't build it. They're not attached to it in any personal way. They're running a calculation. They've effectively stepped into the position of the government with a legal claim that must be resolved. And that claim has a timeline attached to it. The property owner is given a window to repay the debt, taxes, penalties, interest, all of it. If they do, the investor earns a return. If they don't, the process escalates. In many jurisdictions, that lien can eventually convert into ownership rights. Through foreclosure or tax deed sales, the investor can legally take possession of the property, not by negotiating, not by persuading, but by following a predefined legal pathway. And this is where the transfer happens. A relatively small unpaid tax bill, sometimes a few $1,000s, can ultimately lead to the loss of an asset worth hundreds of thousands. Not because the asset lacked value, but because the owner lacked liquidity at the wrong moment. Now, think about the asymmetry here. On one side, you have a property owner dealing with real-life constraints: job loss, reduced income, unexpected expenses. Cash flow tightens, payments get delayed. The situation feels temporary, manageable. On the other side, you have an investor whose entire model is built around these situations. They have capital ready, they understand the timelines, they know the legal process. They're not reacting emotionally, they're executing a strategy. And the system connects these two sides automatically. Pause for a second, because this is the part that feels almost invisible. There's no dramatic confrontation, no obvious conflict. The process runs in the background: paperwork, deadlines, filings, but the outcome is very real. Ownership shifts quietly. Now, to be clear, not every tax lien results in foreclosure. Many property owners do catch up on payments, they resolve the debt, and the process ends there. But the system doesn't rely on everyone failing. It only needs some to. Because those cases create opportunity for those positioned to take it. And over time, this creates a pattern. Distressed owners lose assets. Liquid investors acquire them, not through market competition in the traditional sense, but through legal enforcement of unpaid obligations. And this is the key insight. The insight isn't hidden because it's secret. It's hidden because it's normalized. It's just part of the system. But once you see it clearly, the implication becomes hard to ignore. Your property isn't just something you own. It's something that can be claimed if you fail to continuously meet the conditions attached to it. And in this system, those conditions don't pause. Which leads to another common misunderstanding, that you can somehow structure your ownership in a way that protects you from this. But that's not how it works. This is where a lot of people think they've found a solution. They hear about trusts, LLCs, asset protection structures, legal tools that create distance between them and their property, and it feels like a safeguard. And to be fair, those tools do serve real purposes. They can protect against lawsuits, help with estate planning, limit liability in business contexts. In many scenarios, they work exactly as intended.
But when it comes to property taxes, they don't solve the problem people think they solve. Because the obligation isn't tied to you as an individual, it's tied to the property itself. And that distinction changes everything. You can transfer ownership into an LLC. You can place the title into a trust. On paper, you've created a layer between you and the asset. You're no longer the direct owner in the simplest sense. But from the perspective of the tax authority, nothing meaningful has changed. The property still exists. It still has an assessed value. It still generates a tax bill on a fixed schedule. And that bill doesn't follow your structure. It attaches directly to the land. Pause for a second and think about how that plays out. The system doesn't need to pursue you personally to enforce payment. It doesn't need to challenge your legal structure or unwind your ownership arrangement. It simply enforces against the asset itself. If the taxes aren't paid, a lien is placed. If the lien isn't resolved, the process continues. Eventually, that pathway leads to foreclosure or auction, regardless of how the ownership is structured on paper. So, whether the property is held in your name, an LLC, or a trust, the sequence remains exactly the same. The obligation is issued, the deadline passes, penalties accumulate, the lien is sold or enforced, and if nothing interrupts that chain, ownership transfers. The structure doesn't stop it because it was never designed to. And this is where the misunderstanding becomes dangerous. People assume that by adding layers of legal complexity, they've insulated themselves from systemic risk. But in reality, they've only shifted certain types of exposure, mainly external claims like lawsuits or creditors. They haven't touched the core mechanism that defines whether they can keep the property at all. Because property tax sits at a higher level. It's not just another claim, it's a priority claim. It exists as part of the system that defines ownership itself, not something outside of it. And that means it overrides most of the protections people rely on. So you can have everything structured perfectly, clean paperwork, well-designed entities, proper legal advice, and still lose the asset if you can't meet the ongoing obligation attached to it. That's the part most people don't see coming. Because the question was never, how do I protect ownership on paper? The real question is whether you can continuously meet the condition that makes that ownership valid in the first place.
So what do you actually do with this? Not panic, not abandon the idea of owning property, but you do have to adjust how you think about it. Because if the real risk isn't the purchase, but the ability to continuously hold, then your strategy has to reflect that. This is where most people get it wrong. They optimize for acquisition. They stretch to buy. They focus on down payments, mortgage terms, interest rates. They plan for getting in, but not for staying in under stress. But the system doesn't care how you got there. It only cares that you keep paying. So the protocol is simple, but strict. You need a dedicated, highly liquid reserve specifically for property taxes, not invested aggressively, not tied up in assets that fluctuate or take time to sell. Liquid, accessible, boring. And not just for 1 year, multiple years. Pause for a second, because this is the part people resist. Holding idle cash feels inefficient. It feels like lost opportunity. But that mindset assumes a stable environment, one where income is predictable, markets function, and assets can always be converted when needed. A tax obligation doesn't wait for those conditions. It arrives on schedule. So the reserve exists to bridge uncertainty. If your income drops, if markets freeze, if something unexpected happens, you don't negotiate with the system. You pay. That's what keeps ownership intact. Now think about the implication. Your land isn't secured by fences, solar panels, or self-sufficiency systems. It's secured by your ability to meet a recurring financial obligation. So the rule becomes clear.